Okay, so today we are moving on to our final question, question 5 of the 2018 question paper, Fundamentals of Accounting. Um, so the last question, question 5, question 5 has to do with incomplete records, and you were asked to calculate your sales and purchases amount to draw up your financial performance and statement of financial position statements. So incomplete records or single entry records. This actually means there are type of businesses that do not keep full records of their transactions, meaning that they do not record whatever transaction that happens in the business. For example, if you have a bar, ne? For example, if you have a bar, you think bar tellers or bar ladies or barmen um, record every transaction that happens. Whenever a person buys beer, you think they record everything. No. So mostly these small businesses, they do not keep full records of their transactions, business transactions. But that does not mean that because they do not keep full records, they do not need to draw up financial statements. So if the bank wants your financial statement, obviously you will need to present it. Now, drawing up financial statements of incomplete records, you won't be given some amounts. Obviously, some amounts will be missing, and therefore you will need to calculate them. Ne? There are certain ways on how to calculate missing figures, and they are really well explained in the incomplete records slides. Ne? There are actually 5 steps that you will need to know. 5 steps that you will need to know, and five books or and 5 books, ledger accounts. It's a mixture of books and ledger accounts that you'll need to draw up in order to find your missing figures. So I advise you go to your slides of your incomplete records, then you can read more and understand. Okay, so the first one, question 5.1. So question 5.1, you were required to calculate your sales and purchases amount. So your sales and purchases amount are some of the amounts that you will never be given. Ne? Those are some of the amounts that you will never be given when it comes to incomplete records. But that does not mean that because you are not given your sales and purchases amount, then you do not include them. So how will you draw up an income statement with no purchases, with no sales? Does not make sense. Ne? Okay, that's why you will have to draw up some ledger accounts in order to find your sales amount and your purchases amount. Now, to find your sales amount, you will have to draw up your debtors control account. So finding your sales amount, a debtors control account needs to be drawn up. And to find your purchases amount, creditors control account needs to be drawn up. Okay, so let's start off with our sales first. So we said that we draw up our debtors control account. It's drawn up just like any other ledger in accounting. So I'm quickly going to draw up. Let's just draw it up. Okay, so you have the date here, the details, portfolio, the amount, and the date, the details, portfolio, and then the amount. Okay. Now, just like any other ledger account, this is the debit side, and then you write the heading, which is debtors control account, and then this is the credit side. Now, debtors are assets. Debtors are people that buy on credit from your business. So these are your assets, your current assets, and therefore current assets increases on the debit side. They increase on the debit side and decrease on the credit side, meaning that whatever amount or whatever transaction that increases your debtors, including the balance brought down, will be recorded on the debit side. So whatever information or whatever transaction that affects your debtors, including the balance as well, the balance brought down, is recorded on the debit side. And whatever amount that decreases your debtors, yeah, or whatever transaction that decreases your debtors, it will be recorded on the credit side to show the effect or to show the decrease in your debtors. Okay, so let's go back to our question and find out the type of transactions that affect our debtors. Okay, um, okay. Now looking at the information given, you are given a bank account, in other words, a cash book on top there, which has a balance on January 2017, and down there you are also given other additional information. So down there you're given other additional information, which consists of balances from the previous year. And what did we say about balances from the previous year? They become the opening balances of the current year. So you can see you have 2 years, 2016 and 2017. That means that the current year is 2017. So the balances of 2016 becomes our opening balances in 2017. Okay, so and like just like any other ledger account, the first thing that you record, just like any other ledger account of assets and or liabilities, the first thing that you record in the ledger account is your balance brought down. Now, looking at this two, the information of 2016, we said those are our balance brought downs. And so the debtors for goods in 2016 is the opening balance of our debtors. So you record the date in this case is 2017 January. We said is the opening balance, and opening balance is always on the first day of the financial period. That's why it's our financial period ends in December, meaning that the first day of our financial period is January the 1st. So 2017 January the 1st, you have balance brought down with an amount of how much? So our balance brought down is 9,031. Okay, now that we got our balance, we now look for other transaction that that affects our debtors. Any other transaction that has to do with debtors. So We can look at the bank account that you're given. You are told that the checks received from debtors amounted to 37,936 checks received from debtors. So this means that the debtors paid off their accounts. Now, when debtors pay off their account, what happens to your debtors? Let me say a person was owing you $100 and then she came back and paid back the $100. What happened to her account? Her account decreased. She's no more owing you. She was owing you lately, but because she paid off her account decreased, meaning that your debtors will decrease. Debtors decrease when the debtors pay off their accounts. So debtors checks received from debtors amounted to 37,936. So we said that transaction that decreases our debtors is recorded on the credit side. And in this case, these are the rest of the information were done were recorded at the were found at the end of the financial period. In other words, they are to be recorded at the end of the financial period. So we have 2017 and our financial period ends in December the 31st. So you have bank. Remember, where are we getting this transaction from? We got it from our bank account that were given on top there. This is the bank account. So we receive checks. In other words, a check already tells you that it's bank. The form of payment is bank, or the other account is bank. Of 37,936. 37,936 is the total amount paid by the debtors. Okay, now we move on and find out, do we have any other information that has to do with debtors? So let's read in the small paragraph between the two, two tables. All business takings were paid into the bank with an exemption of 9,630. Out of this, wages of 5,472, drawing of, okay, purchase of goods. Okay, here there's no information that has to do with debtors. So we move back again to our additional information. We have closing debtors. Ne? We have closing debtors. And closing debtors, a closing balance, in other words. We said that information of 2016 is our opening balances, but information balances at the end of balances in 2017 are our closing balance. They are our closing balance, and therefore the 8,624 is the closing balance of debtors, and closing balances of debtors are recorded on the credit side. Closing balances of debtors are recorded on the credit side. That's why you have balance carried down. Remember, it's a carried down of how much? Of 8,624. Of 8,624. Now you move back, you go back to your transaction, to your table. Do you have any other information that has to do with debtors? No. So these were the only information. Okay. Now another thing that I want to talk about is debt when you speak of debtors, these are people that buy on credit, ne? So you only record credit transactions in the debtors control account, meaning that if we had cash sales in here, ne? If we had cash sales, then we could have not recorded the cash sales in the debtors control account. So we only record debtors have to do with credit sales only. So the amount that you get when you draw up your debtors control account, the amount that you get is your credit sales. Therefore, if there is any cash sales, you will have to add the two amounts together to get your total sales that you are looking for. But in this case, um, there was no cash sales. So we balance off our accounts. Now, what did we say about balancing off? When you're to balance off your accounts, what you do is you add up the two sides. Obviously, by looking at this table, you can tell that the credit side is the biggest. You can tell by the credit side is the biggest. So let's try balancing. So you have 37,936 plus 8,624, and then you get 46,560. So you record the amount on both sides, 46,560. You record it on both sides. So 46,560. And then from there, after recording it on both sides, you find the difference on the smaller side. You balance off the smaller side. So 46,560 minus the amount that is on the smaller side, so minus 9,031, will give you your total sales amount that you are looking for, which is 37,529. And these are your sales amount, which is a missing amount that you are looking for. And this transaction happened in December the 31st. So the balance brought down is the only transaction that is recorded on the first day of the financial period. The rest of the transactions are recorded at the end of the financial period. Okay, so we got our final amount that you're looking for. This is actually the amount that we were looking for. Okay, so we move on. Um, and make sure your balancing figures, which is now the 46,560, is always underlined in double lines to show that that is the final amount. Nothing else will be added after that amount. So that was our debtors control account, and that's how we calculate our sales amount when we are asked to calculate sales amount. So when you're asked to calculate your sales amount, what you need to do is you have to draw up a debtors control account. That's the only way you can get your sales amount. Now that you're done with the sales amount, we move on to finding our purchases amount. And we said that finding our purchases amount, you draw up a creditors control account. Purchases has to do with creditors. Credit purchases has to do with creditors. You are the one that the business is the one that goes out and purchase and buy stock. And when you buy stock, it's referred to as purchases. Ne? So when you buy stock on credit, people that you buy stock on credit from are known as your creditors. That's why when you are not given your purchases amount, then you'll be required to draw up a creditors control account to help you get your purchases amount. So let me quickly just draw the table. Okay, just like any other ledger account, we have the debit side here, and then the name of the book, which is in this case is creditors. creditors control account, and then we have the credit side. Okay, so we have the date column, and then you have the details, portfolio, and then you have the amount, and then date again on the credit side, the details column, portfolio, and the amount. Okay, once you're done, this is now your creditors control account, and that is the ledger account that will help you to get your purchases amount. Okay, now when we speak of creditors, these are people that you buy on credit from. So these are your current liabilities. When you owe people money, those are your debts. Ne? Those are your debts, and debts are known as liabilities in accounting. So in this case, it's your current liabilities, because you are expected to pay them off within a period of 12 months. There's no way you owe somebody $100 and wait for 10 years or a year or 5 years in order to give that $100. So obviously, if I give you $100 today, or if you buy something from me today, I'll expect you to pay it before even month end. That's why it's a current liability. It's to be paid within the year. Okay. So a creditors control account, because it's a liability, it's a liability type of account. It decreases on the debit side and increases on the credit side. Now let's record info, meaning that all all transactions that increases our creditors, including the balance brought down of your creditors, are recorded on the credit side. And all transactions that decreases our creditors, including the balance carried down or the balance at the end of the financial period, are recorded on the debit side of your creditors control account. So meaning that we say that the first thing that you always record when it comes to ledger accounts of assets and liabilities, the first thing that you record always is your balance brought down. And it's always recorded on the first day of the financial period. Okay. So we have on the credit side, we said the balance brought down of creditors or of liabilities is always on the credit side. In other words, balance brought down in most cases is always on the side on which the account increases. That's why you have 2017, and it's always on the first day, January the 1st, we have balance brought down. So now looking in our transactions or in our accounts that you're given in our additional information, creditors for goods, creditors for goods in on the 31st of December 2016 was 5,624, meaning the closing balances of 2016 becomes our opening balances in 2017. That's why you have a balance of 5,624. 5,624 is your balance of your creditors control account. Okay. And then from there, now that you have recorded your balance carried down, you now record every information that has to do with your creditors. So every information that has to do with your creditors, you record it. Now looking at if you check in your bank account, you are told that payments of trade creditors, the total payments that you made to your creditors was 29,487. That was the total payment you made. And we say that when you pay off your creditors, what will happen? Let me say you were owing game today. and then you decided that you are going to pay off your account, what happens to your liabilities, to your debts? They are decreasing. What happens to your creditors? They are decreasing because you paid off your account, and because they are decreasing, it will have to be recorded on the side on which your creditors control account or your creditors decrease, and this is on the debit side. And we say that all other information apart from your balance brought down, they are recorded on the last day of the financial period. Therefore, it's 2017 December the 31st. Okay, and so we have under details, we have payments of creditors. So in this case, you are taking this information from your bank account. So you paid through the bank, or you gave a check. Check is also bank, of how much? Of 29,487. So why are we not writing payments of trade creditors here? Because of the double entry principle. There are two accounts involved in this transaction. The first account is your bank. Your bank is decreasing, and the second account is your creditors control account. It's your creditors, right? So in this case, the bank ledger account is the one that you are given on the question. Ne? So when you are to draw up your, that's why it's written creditors, payment to creditors in your bank ledger account. So when you are going to draw up your creditors control account or your other ledger account, obviously, in details you will write the form of payment. In the bank account, you are writing to whom did you pay the money to. It was to your creditors. Now, in your creditors control account, you will have to write the form of payment. How did you pay the money? Was it through the bank or was it cash? Now, in this case, it's bank because it comes from your bank account of 29,487. And then you go on. What other transaction that you do you have that has to do with your creditors? You have your balance carried down. Balance carried down of 7,389, and we say that balance carried down of creditors is always on the debit side, on the side that it decreases. So on the debit side, you have balance carried down of the amount of 7,389. Amount of 7,389. And then from there, you will have to balance off your trading you will have to balance off your creditors control account. Now, to balance off your creditors control account, the same way you balance off your debtors control account, you'll have to add up the sides. Looking at this, the debit side is the biggest, so you have to add up the amounts, which are 29,487, 29,487 plus 7,389, and the amount is 36,876. 36,876. So you record it on both sides, 36,876. Okay, and then from there you find the difference on the smaller side. You find the difference on the smaller side, which is now 36,876 minus 5,624. You're balancing off, remember. Then you get an amount of 31,252. You get an amount of 31,252. So this is your credit purchases. Okay? And this amount or this transaction is on the 31st December 31. Okay. Now that you got your credit, now that you got your credit sales, you check, do you have any cash purchases? Because you're asked to calculate your purchases amount, your whole purchases amount. Now you check, do we have any cash purchases? So you are told that all business takings were paid into the bank with an exemption of 9,630. So you had cash of 9,630. Now out of this cash of 9,630, you paid wages, you pay drawings and purchase of goods. So you also have cash purchases. Now, because you have cash purchases, you will need to add the two together. So you record total purchases so your total purchases equals to credit purchases plus cash purchases. And therefore you will have your credit purchases is the one that you calculated. So it's 31,252, and then you add your cash purchases that you are given in the transactions there, purchase of goods of 2,904. So what will be your total purchases in this case? So your total purchases will be 31,252 plus 2,994. Oh, this is slow. 2,904. So your total purchases were 34,246. Those were your total purchases, and that is the amount that you were looking for. Meaning that in cases where you have your cash purchases or your cash sales, you will need to add them to the credit amounts. Like in this case, creditors control account, you had cash purchases, and that's why you had to add it to your credit purchases. Meaning that if we had cash sales here, we could have done the same. Total sales equals to credit sales, the amount that you got here, plus your cash sales that you are given, and then you get your total sales for the year. Okay. Are there any questions? Are there any
No,
questions?
I understand so far.
Pardon?
No questions.
Okay,
No question.
that's great. So that was the solutions to the first question of your sale of your question 5.1. So the next one, you are asked to draw up a statement of financial position. So you are asked to draw up a statement of financial position. Before we move on, I would like to ask if you still have time. We can move on, or we'll end here for today. So should we move on or what?
We can move on up to 8:30.
For up to 8:30.
We can move on up to 8:30.
Okay.
Mm. I think we can do question 5.2. Mm.
Okay. So question 5.2. So question 5.2 is you're asked to find you took out to draw up your statement of financial performance. That in that case is just statement of it's your income statement or statement of comprehensive income. So statement, you first write the heading. That's the first thing that you always have to record: statement comprehensive income. And then the name of the business, which is the School of Accounting, of the School of Accounting for the year ended 31 December
Mami, trading, yeah,
2017.
I'm from,
Okay.
yeah. Mami,
Okay, there's someone talking on the background, so if you have a question, you can just always unmute yourself because I had to mute you now. Okay. So statement of comprehensive income for the School of Accounting for the year ended 31 December 2017. So I'm quickly going to draw up our table. So it's always a 3-column table. Whereby you first start off with your sales amount. Remember, this is an income statement. The first thing that you record is your sales amount. Now our sales amount, we calculated it and we got 3,529. So we got 37,529. So 37,529 is our total sales amount. And then what do you do next? You less cost of sales. You less your cost of sales, and because we are always not given cost of sales, you are required to calculate it. We know that formula of calculating cost of sales is opening inventory so you're opening inventory, you add purchases, and then you less closing stock. Okay, so what was our opening? And because these are not final amounts, that's why you will have to record it in the middle column. I said that uh, in the last column you only record your final amounts. Now our opening inventory was 13,862. So 13,862 was our opening balance. And then we add our purchases amount that we just calculated. So our purchases amount amounted to 34,246. 34,246. So 34,246 was our total purchases amount. And then you add up your amounts together. You add up your amounts together, which is 13,000. So opening stock of 13,862 plus 34,246. will give you an amount of 48,108. Ne? And then it says you less your closing stock. So how much is our closing inventory? Let's use the same term. So how much is our closing inventory? And all amounts subtracted should always be in brackets. So our inventory amounted to 15,000. Our closing inventory amounted to 15,144. Yeah? I hope you can all see where I'm taking the amount from. Balances of 2017 are our closing balances. So 15,144, and then you get your closing stock of 48,108 minus 15,144. Okay, and then from there you get your total cost of sales of 32,964. So 32,964 is your total cost of sales amount. So sales less cost of sales will give us our sales less cost of sales will give us what? It always gives us our gross profit. Always gives us our gross profit, so we have to add up these amounts. So how much is our gross profit in this case? So 37,529 minus 32,964 will give us an amount of 4,565. 4,565. And then we move on. We add all incomes received. So we add other income if we are given. So we go back to our question and find out, do you have any other income? No, we actually do not have any other income. Ne? We actually do not have any income. So the next thing that we do is we list all expenses. We list all expenses. So what expenses are we given there? Now, what expenses are we given there? Looking in the rent, looking in the bank account, we have rent. So rent that was paid through the bank is 1,650. So you check in the transactions that were paid by check. Did we pay rent out of these transactions? No. So rent, our amount of rent is 1,650. And then from there we move on to our next expenses, which is rates. So the rates that were paid through the bank was 890, and those were the only rates that we paid. So 890, 890. And then the next one we have sundry expenses. We have sundry expenses, and sundry expenses were amounted to 375. 375 was our sundry expenses. And then the next one, now you check what other expenses do we have here? What other expenses do we have here? We are told that wages, we paid wages of 5,472. Wages is also an expense and therefore should be recorded. Wages of 5,472. 5,472. Okay. Now that you're done, we move on. Oh, sorry. When it comes to rent, ne? When it comes to rent, so sorry, I ignored some transactions. When it comes to rent, when it comes to expenses, you make sure you have to check the additional information, look for the accruals and prepayments. Ne? So one thing that I wanna teach you is the effects of accruals. So accruals at the beginning of the financial period are subtracted, and accruals, well, accruals at the end of the financial period are subtracted. Okay, so accruals at the beginning of the period are added, while accruals, what am I writing? Sorry. Accruals at the beginning of the period are subtracted, while accruals at the end of the period are added. And then we move on to prepayments. Prepayments at the beginning are added, and prepayments at the end of the financial period are subtracted. Okay, so prepayments at the beginning of the period, okay, so meaning that all accruals at the beginning of the financial period are subtracted, while accruals at the end of the financial period are added. While prepayments at the beginning of the financial period are added, and prepayments at the end of the financial period are subtracted. Now that has to do with accrued expenses. It has to do with your expenses. Now looking at the information given, you are told that rates prepaid, you have rates prepaid at the beginning. You have rates prepaid. That's a prepayment, prepaid prepayment. So you have rates at the beginning and also at the end. So what did we say about prepayments? So we have the original amount that is paid, 890. So we have to add the prepayment at the beginning of the period, which is 210. Ne? So you plus 210, prepayment at the beginning are added, while prepayments at the end are subtracted. And then you subtract 225. Ne? Make sure you always show or do your show your calculations. So 890 plus plus prepayment at the beginning of the year minus prepayment at the end of the year. Why do we minus prepayment at the end of the year? Because prepayment at the end of the year does not belong to this current period, meaning that we are in December and then you paid for January again. January belongs to the next financial period, and therefore information that does not belong to this current financial period should be subtracted. So 890, let's quickly do the calculations. 890, you add 210, you minus 225, and then you get an amount of 875. So our amount of 875. Okay, and then we move on. I think we also had another accrual. We had an accrual of rent owing. So rent owing, at the beginning of the period is subtracted, and or accruals, rent owing meaning accrued, it is not paid, it's owing, it's not paid. Therefore, rent at the beginning is subtracted. That's why under your under your rent you will have 1650 minus 1650 minus 150 will give us how much? Obviously that will give us 1500. Okay, now you check what other expenses are we given there. We know that drawings are not expenses, so we leave it out. The next expenses that we have there is an expense that you always have when we have fixed assets. Whenever we have fixed assets, we should have that expense, and that is depreciation. So depreciation is our next expense that we need to record. And how do you now find, in this case, how do you find depreciation if you are not even told of the method of depreciation, or you're not given percentages? So what you need to do is you compare the amounts of your fixed assets in at the beginning and at the end. So at the beginning, and now the fixed asset that you have here is fixtures at valuation. So at the beginning we have fixtures worth 2500, but now it's just 2250. So the 250, the difference of 250, you can tell now in 20 at the end of 2017 our fixtures and fittings decreased, and when our fixed assets decrease, that is known as depreciation. So the decreasing amount is depreciation of 250. So you have depreciation of 250. Now that we are done with all our expenses, we have to add them up and then record the amount. So let's try recording up all our expenses amounts. Excuse me. So we have 1500. We have 1500. We add 875 plus 375 plus 5472, and then we plus 250. And then we get, our expenses are a lot, are more than our income. So we got 8472, and then that is our expenses. So gross profit less expenses, you will get your net profit or net loss. And but in this case we have a net loss. A net loss of how much? So let's quickly calculate our net loss. So we made a net loss of 4565 minus 8472. So we made a loss of 3907, and it should be shown in brackets to show that it's a loss. Okay, so that was the end of our question 5. Question 5.2 of our statement of comprehensive income. So what you do is you had your sales amount. So it's just the normal income statement, the normal income statement that you usually draw, which is sales less cost of sales, and then you get your gross profit. and then from there you add all your income, other income. But in this case we had no other income, so we less all our expenses. But looking at the information that you're given, our expenses amounts were more than our income, our gross profit, and that's why we made a net loss of 3,907. So that was it of question 5.2. Unless you have any other questions, please unmute yourself, and if you have questions, you can ask me. Any questions? Is
So with
everything
the
okay?
uh, I want to ask here with the drawings.
Mm-hmm.
Did we calculate that? Did they use that amount on the drawings
Okay,
on the added information?
drawings are not expenses. We will use drawings in
Mm-hmm.
the statement of financial position. So in the statement of financial
Oh.
position, when we are to record our drawings amount, we will have to add both our drawings that we paid by bank and our cash drawings together. Then we get our total drawings amount.
Mm-hmm.
Yeah.
Okay.
Mhm. Any
Okay.
other
I
questions?
know everything looks clear.
Okay.
I. Mm.
Since you do not have any other questions, yeah, just go through the slides. They are well explained, all the 5 steps, everything that you need to know, because you will need to know all the 5 steps. Everything is clear, well explained. And yeah, if you have any other questions, or if you're struggling, if you happen to be struggling with anything when you're going to read through the slides, please feel free to ask me on the group. I'll be available anytime to help. Okay.
Okay.